All right, good morning, everybody, and thank you very much for joining on behalf of the CFA Society of Orlando, and welcome to our first virtual event of 2020, Coffee with the Fed. A couple of housekeeping items before we get started. If you have used Zoom, you're probably familiar with the Q&A button at the bottom here of the screen. If you're not, please go ahead and submit any questions that you have for our presenter as we get through that part of the presentation. We will be doing a Q&A session at the end of the presentation. So as you have questions, feel free to add them to the Q&A, and we will be sure to spend some time discussing those when we get to that particular point of the presentation, which is towards the end. Next, we always like to make sure we take care of this, which is thanking our annual sponsors. If it wasn't for them, we wouldn't be able to put on any programming via virtual person. JP Morgan and Invesco have been our gold sponsors for a number of years, so we thank them for that. And then silver sponsors being BlackRock, Parametric, Pershing, State Street, and Russell Investments. So if any of these particular organizations you have questions for, comments for, please feel free to reach out to the board. We're happy to connect you with members of their teams to make sure that your needs are met. Another thing I wanted to share also is, what have we been up to while we've been working from home, so to speak? Obviously, we haven't had any in-person events since our forecast dinner, which was in 2020, I promise, even though it seems like that was 2 or 3 years ago. A couple of efforts we've been doing on the society board side, one of which is the Investors First podcast. So we've had new episodes every single Thursday of that. We started it in just about early March of 2020. I also want to give a shout out to Steve Curley and Colby Donovan. They have been the spearheads on this particular effort. And the Society of Orlando also won an award for our podcast, the 2020 Impact and Innovation Award from the CFA Institute up in Charlottesville. So if you want to subscribe, you can listen on Apple Podcasts, listen on Spotify, Breaker, or to make it even easier, if you just Google the Investors First podcast, you'll find a way to our website and be able to listen to any of our past episodes. So that's first and foremost. And then secondly, I'd be remiss if I didn't mention Chris Cannon. Chris Cannon has been on the board of CFA Society for a number of years, one of our most active volunteers, and he received recognition for his volunteer efforts, earning the Volunteer of the Year award for 2020. So if you know Chris, please be sure to reach out to him, congratulate him, and be sure to be a member of the society for the efforts he has put in. And last but not least on this side of things, if you want to keep up with what we're doing digitally, since our events aren't happening as often, feel free to follow us on LinkedIn, on Twitter. That's where you'll find the most up-to-date information on podcast guests, the most up-to-date information on events. So we greatly appreciate anyone who's able to follow us on those sites and keep track of what we're doing. Another feature we're going to be using today is polling technology. So to get us started here, I have a quick question for the group. If you'd like to go ahead and participate, Ali, if you could bring that up. So our question here is, in total, how many Federal Reserve banks, Federal Reserve districts are there across the United States? So go ahead and answer that when you get the opportunity. And while you're answering that, I want to go ahead and introduce us to our speaker today, Chris Oakley. Chris Oakley is the Vice President of the Jacksonville branch of the Federal Reserve Bank of Atlanta. Chris Oakley has been a member, or should I say, a part of the Fed since 1988. And he's the regional vice president of the bank's Economic Information Network. In this role, he serves as the lead regional executive, assuming responsibilities for coordinating those strategic plans, outputs, and talent pipelines. And he was a graduate of Georgia Tech. So with that, I'd like to go ahead and turn it over to Chris.
Great. Well, good morning. Thanks, Frank. I appreciate it. And thanks to Frank, Steve Curley, who I've known for a while now. And I want to thank Allison as well. And before I forget, my colleague is also part of the event today, Chris Viets, who helped pull together the deck we're going to use. So I want to be sure to give her a shout out as well. And I'll also give you a bit of an unsolicited commercial for the podcast, which I just think is outstanding. As a matter of fact, I told Steve yesterday that it's amazing to me that this has just gotten off the ground, because these folks sound like they're old pros at this. So I'm seeing on my screen anyway that the poll results have come up, and we've got, looks like the majority thinking we have somewhere between 11 and 15 districts. Next would be 6 to 10, and then we've got a small minority that think we have more than 16. So as we get into the presentation, you'll see that. My plan today is to talk a little bit about the Fed itself. I think because of the nature of the work that you guys do that are part of the CFA Society, most of you are pretty familiar with this, so my apologies to those that are already Fed experts. But occasionally you got a few participants that maybe need to get a bit of an update. So I want to do that. I do want to spend a few minutes talking about the Regional Economic Information Network. That's the initiative that Frank mentioned that I'm a part of. And so we'll spend some time on that. And then we'll spend the bulk of the time actually talking about economic performance. And obviously this has been an unprecedented year. And so there's a lot to talk about. So on my screen, I can see that my disclaimer is at the bottom there, the title. And basically that's saying to everybody that the views expressed are my own. There's actually only one person that can speak for the Federal Reserve, and that's Chairman Powell. And so all the rest of us are representing our own views, though mine, of course, are informed by the work that we do at the Atlanta Fed. So Allison, we can go to the next slide. And just a quick reminder that the Fed has two primary responsibilities. These are given to us by Congress. It's basically the employment mandate and the inflation mandate. And so by employment, obviously we can't directly impact employment, but the idea is to create conditions through Fed policies that contribute to maximum employment. The second part of the mandate is the price stability mandate or inflation. And so basically you're looking to have low and steady prices. Going into the early part of the year, I think most Fed officials would say that we were meeting both of those mandates. And then, of course, we were faced with a global pandemic. So we'll be talking a lot about how that's impacted this part of what we do. But before we get there, let's move on to the next slide, which will give you a picture of our leadership. And so the Federal Reserve is an interesting entity. As a reminder, we were created by an act of Congress back in 1913. The Federal Reserve Act was signed by President Wilson. And the idea was to have a central bank that had both elements of the public sector and the private sector. And so the Board of Governors is the more government-like part of our organization. And so the folks that you see up on the screen are the members of the board themselves. These are the Federal Reserve governors. These are presidential appointees who are confirmed by the Senate. But the idea is for these folks to not be influenced by a particular political persuasion. And so they have 14-year terms. And so the idea here is that if they serve their full term, they're going to survive the president, so to speak, that appointed them. You also see that we've got a chair and two vice chairs listed there. Those terms are more limited, though the terms of governor themselves remain the 14 years. So you could conceivably have a situation where a Fed participant could actually move off of one of these roles and remain a governor. You'll also see that there are two vacancies currently. And so again, we are at the pleasure of the president and ultimately the Senate to get those folks approved. And so there are candidates that are in that process at this point. So we will wait and see if they actually make it through the Senate confirmation part of this process. But you can see these folks are the other members of the board. And then if we go on to the next slide, you get a picture of the other side of the Reserve Bank or the Federal Reserve System, and this is the Reserve Banks themselves. So here is the answer to the polling question, and that is there are 12 Federal Reserve districts. Each of those have a bank, and each of those banks have a president. These presidents are actually named by their respective boards of directors. So each of the Reserve Banks have their own boards. The boards are a combination of all kinds of folks that represent different parts of the economy. And so they play not only an important role in providing us with real-time information on what's happening on Main Street, so to speak, but they also are the entity that names their respective president. But I should mention that is not without oversight of the Board of Governors. The board ultimately blesses the individual who is nominated. And as you can see, you've got the pictures there of the various 12 Reserve Bank presidents. In the Southeast United States, Raphael Bostic is our president. And also just direct your attention to what the 6th Federal Reserve District looks like. We are a large district. The last time I checked, the economy of the 6th District was something like the 7th largest in the world if we were to become our own country. You can see, again, our head office is in Atlanta. You're already aware that we have a branch in Jacksonville, which is where I'm talking to you from today, or at least the city. I'm actually talking to you from my son's bedroom. But the office itself is in downtown Jacksonville. Florida is somewhat unique in that we have 2 branches. So Miami, which not only is the 2nd office in the state of Florida, but it's also the newest Federal Reserve branch, although new is not super new because they were established back in the early 70s. We also have the distinction of having the oldest Reserve Bank branch, and that's New Orleans, which was established right after the 1913 naming of all the 12 Reserve Bank locations. And then we have branches in Birmingham and Nashville as well. So again, one of the things that's really cool about our district is the fact that it is super diverse. As a matter of fact, the collection of business and industries in the 6th Federal Reserve District looks almost identical to the U.S. as a whole proportionally. And so the information that we're able to gather can be super useful in terms of getting a picture not only of what's happening in the Southeast, but it serves as a pretty decent proxy for the country as a whole. So Allison, we can go to the next slide. And it's a great segue into this network that I mentioned. And so RAIN is somewhat unique to the Federal Reserve Bank of Atlanta. This was something we created about 12 years ago. And the idea was really to take advantage of what I just described, a very large district, a district that is very diverse economically. And I mentioned earlier the board of directors of the Reserve Bank itself, but each of the branches has a board also. And so in effect, we had a built-in network of people that represent the economy. And so on a branch level, you're going to have people that are geographically diverse, and again, that represent different types of businesses and industries, even the nonprofit sector, and so on, so that you can get a really good picture of what's happening in the economy simply by asking a few questions. Let me tell you a little bit about how this process works. Allison, if you go to the next slide, this is a very simple and simplified picture of how this works. So, you know, we go up to the very top of the picture. So at 12 o'clock there, you see the public. And what I mean by that is this is where my colleagues and I are out asking questions of folks like you, people that are participating on the call today, your clients particularly. When we started RAIN, we actually focused on the largest revenue producers in our territory. And that was a way of trying to very quickly establish a collection of contacts that could provide a very broad view, not only of their industry, but broadly of their region or the entire country, and in some cases internationally. And so most of the large entities that have a presence, either a headquarters or a large regional presence in our district, we likely have a relationship with that CEO or the CFO of that organization. But as this initiative matured, we wanted to make sure that we were talking to everybody. So we've expanded our collection of contacts to include medium-sized businesses, small businesses, governmental entities, nonprofits, academia, again, pretty much anybody that is a part of the economy. And in any given FOMC cycle, we will typically talk to somewhere in the neighborhood of 125, 150 of these contacts in normal times. But as I mentioned earlier, and as we look around the videos, a lot of us are working from home now. Certainly there's no travel. Folks aren't really excited about having me come into their office these days. And so we have really ramped up our efforts by doing telephone and video interviews. So we've been in FOMC cycles more consistently lately talking somewhere in the neighborhood of 200 or 300 contacts, which has actually been super helpful during this period. During the course of the FOMC cycle, we're also, of course, trying to synthesize the information that we're getting from these folks. And then taking that information, comparing it with what we're hearing from other parts of the district, and ultimately pulling together a story that is supplemented by the various branch boards of directors. And so, as I mentioned earlier, each office has a board. In the case of the branches, the boards really serve as an advisory entity and in effect are super contacts. And so it gives us a chance on an every 6 to 8 week period to kind of touch base with this group and to make sure that the things that we're hearing from the broader collection of contacts really make sense. That information is all pulled together at the end of the cycle. So again, by cycle, I'm talking about us preparing Raphael to go to the FOMC meeting. So we share that information with our economist colleagues in the research department. We get a chance to report out to Raphael. So you see around 6, 7 o'clock where we're reporting to the president, following our efforts being informed by the conversation at the Atlanta board meeting. We get Raphael ready to go to Washington. And so what he's doing at that point is taking not only the information that he's gotten from our team of economists and analysts, and they're using, of course, all of the data sources that are coming in, including some Fed efforts to gather information. That's being supplemented by the work that my RAIN team has done. And ultimately, I think helps to inform Raphael's thinking about policy. So not just from the perspective of the data, but also from the perspective of the voices that we hear from Main Street. And I can't emphasize enough to you that in a period like we're in right now, when things are changing so rapidly, these voices are even more important than usual, because by the time we get the data in, oftentimes that is a bit stale and certainly isn't forward looking. And so we really rely on folks like you in the room, as well as our broader collection of contacts, to give us a forward looking view as to what's happening in the economy and what they think is going to happen. Raphael then takes all of that and uses that as he thinks about his own position on policy. He goes to the Federal Open Market Committee, which again is the collection of the governors and the presidents that you saw in the previous slides. Policy is made, and that policy impacts all of us as participants in the economy, and then the cycle kind of begins again. And so again, I can't emphasize that this is very, very much simplified. Fed policy obviously has an impact that goes well beyond any one cycle. But again, this gives you a sense of kind of how we visualize how this process works during any given FOMC cycle period. So I'll stop there. Enough about RAIN. I will say this, if we were in person, I would be showing you a video right now, but we found that the technology tends to not want to cooperate when you do that in a Zoom call. So we'll save that for the next time we meet, but it gives you a good idea of not only how the process works, but even who some of our contacts are, because we've been able to twist some arms and get people to participate, to share their experiences of being a part of this. And I mentioned that because it's actually pretty important, and that is the participants that are a part of this, we keep what they share with us very confidential within the bank. So while it informs our thinking, in order for us to get the most current and the most credible information, our contacts have to believe that we're going to treat that information very carefully. And so we take that very seriously and try to make sure that we're going to do that. So I'm going to switch gears at this point and talk to you a little bit about the economy. And as I said at the outset, there is a lot to talk about. If you go to the next slide, I'm going to reference Chairman Powell a number of times. Here we've got a series of quotes that you're going to see. So this one is actually pretty recently, and it's really, you've heard Chairman Powell make this comment in various ways since the crisis began. But basically the message is that we are going to use our tools to do whatever we can for as long as it takes to provide relief and stability to the economy. And he has emphasized that in any numerous ways, as well as the other governors and Federal Reserve, bank presidents. Going to the next slide, you're going to get a sense of what happened at the most recent policy meeting, which, if my memory serves, I think was last week, although I will tell you the days run together anymore. when you're working from home. But I think the policy meeting was last week, and of course, Chairman Powell holds a press conference after each of these meetings. I'm not going to go into all of this, but obviously the top bullet is the thing that we are most aware of, and that is the fact that this is a global health crisis. And, you know, at the end of the day, it's all about individuals' health and hopefully getting through this so that the economies, both of the United States and the global economy, can move on. But, you know, when you're dealing with this in your own family, you're focused on the human toll that this takes, and we want to emphasize that we certainly recognize that. Looking at how the economy has been impacted, you know, there were no surprises as to what happened. I mean, when you shut down an economy, you can expect to have a massive impact, and that's exactly what happened. And so we saw that after the sharp declines of the mandated shutdowns early on, that we had tremendous impacts. But since then, we've had activity and employment pick up somewhat. But of course, it remains well below the levels that we started. And by the way, I should mention that we started the year in a very good place economically. And that has come back a bit at this point. One of the things that we'll talk about is a bit of the pause that perhaps we've taken. So I'll get to that shortly. Just another couple things I'll mention on here is that we've seen financial conditions improve, and yet some of the facilities that the Fed has stood up, we still want to have in place to serve as backstops. And then, you know, we're watching demand and other things that are holding down inflation. So all of this I'm going to talk about in more detail. So Allison was right to proceed. So we'll go to the next slide with another quote from the chair. And that is to talk a little bit about, again, this is from the end of July, so we didn't have the latest GDP numbers, but you can see where Chairman Powell was predicting that the contraction in the second quarter would likely be the largest on record. Now, Allison, if you go to the next slide, you'll see that, again, no surprise there, that's what this looks like. But before the presentation got started, Frank and I were talking about how some of these charts had to get tweaked, in other words, expanded to be able to capture the full extent of the impact. So here we're looking at overall growth. And of course, the way to read this slide is the various colors in any given column represent either additions or subtractions to overall growth. And of course, if you look at first quarter of 2020, we began to see the impact of the mandated shutdowns. But remember, those were happening toward the end of the quarter, so you only got just a bit of that. And the primary impact was consumer spending. So if you aren't able to read it, the biggest part of that column is the green shaded part, and that's the spending that all of us do. You move into the second quarter where you have now 2 or 3 months of impacts from some of these shutdowns, and you can see a very, very steep decline in overall output. Again, not a surprise to anybody, but when you're talking about records, it's certainly noteworthy to look at this. By the way, that line that is running through there gives you kind of where the final number ends up, because you've got, even in the second quarter there, you see some growth in government, for example. And so you have a bit of an offset. So where the black line ends up landing gives you a sense of what the overall number ended up being, which I want to say was right around negative 33%. Annualized for that quarter. If we go to the next slide, again, another quote from Chairman Powell here. This one is because I'm teeing up some slides that I'm going to be showing throughout the remainder of the presentation. And these are the summary of economic projections. So if you are not familiar with these, or if you don't reference these, this is something you might want to consider doing. So every other FOMC meeting, the participants on the Federal Open Market Committee provide their input on a number of questions. And collectively, these are called the summary of economic projections. And I use this quote because I think it's important. The chairman points out that it does not represent a committee view. It is the individual participants and what they think is most likely based on appropriate monetary policy. And by the way, these submissions are done before the Federal Open Market Committee actually takes place. So again, kind of going into the mechanics of how the process works, at least for our district, ahead of that particular meeting, we kick these around quite a bit to get everyone's input on what folks' views are of the various responses. One of those being GDP as an example. And so we get an opportunity to influence Raphael. At the end of the day, he makes the call on what he thinks those projections should be, and they are submitted to the group. So ultimately what you end up seeing revealed at the end of that meeting is this collection of these projections. So while they don't represent a committee view, I do think they are informative. And so if we go to the next slide, you'll see the first one of those, which is the SEP for gross domestic product there. And so again, what you're looking at on the left-hand side of the chart is where have we actually been? And of course, everybody is very familiar that we have been in this space of running right around 2% growth and very stable growth actually for a long period of time. What you're seeing there under the 2020 column is the collection of votes. So the red line represents the median of those projections. So half of the participants are above, half are below. The central tendency basically just lops off the most extreme views. And then the broader range there gives you the sense of what the more extreme members, so to speak, of the committee are. And so as you can see for year end 2020, so that's what these are looking at, is as of the end of each of these years, what are the participants' best guess? You're coming somewhere in the neighborhood at the median level of about -6% once the entire year has been taken into account, with somewhat of a bounce back as you go into 2021 and ultimately getting right back to where we were before over the longer term at 2%. Now, I want to emphasize here that these are just projections, and I compare this oftentimes to trying to predict the weather. The thing that I think is cool for the committee is that they get an opportunity to update their views every quarter, and their updates are based on incoming data and, again, what they're hearing from folks like you. And so while it's good to look at this, I think it's also important to track the changes from quarter to quarter to see how the committee may be seeing things change in the economy that would influence what these types of projections actually look like. So now we are going to go to the first polling question that we have put together. And I'm going to warn you, this is wordy, so apologies in advance for this. I'm not going to read through all of these, but what we're trying to get is a sense for how your average client, so again, for most of you that are providing services to others, the question is really focused on what your average client has experienced from a sales or revenue perspective. If you are actually in the business world yourself, you can answer directly on behalf of your organization. But for folks that are providing insight and intelligence to others, you can answer based on the views of your average client. Again, we're talking about sales and revenue. And the first couple of responses get at those entities that actually saw those increase since March. And I'll just give you an example of that, just things that wouldn't be a surprise to you. If you're in the grocery store industry, for example, you may have seen your revenue increase. So the question then becomes, do you expect that to remain elevated over time, or will that come back down? Again, we're trying to get a sense of changes that could be more permanent or long lasting. The third option is that your sales revenue are consistent with pre-pandemic levels and are expected to remain so. And then 4, 5, and 6 get at entities where sales declined, but you expect a recovery, and we're trying to get a sense of when you expect that recovery to take place. 7, your sales or revenue declined and you don't expect to recover. And 8 would be for those entities that are actually likely to shutter part or all of their business. And so if you could vote, I think you just tap your screen there and we'll get a sense of what you or what your clients in general are experiencing. And I know Allison is running the show here, so I imagine she is watching results come in, and she'll give us the answers once we have enough participation. So if you've been working while I've been talking, this is a good time to come back to this screen and tap your choice. Allison, can we get to the answers? Is that working? Or it may be like me, it may take a minute to tabulate. So, okay, well, this is really cool. And by the way, Allison is going to take a screenshot of this so that we can take y'all's answers on board into our own deliberations and compare it to what we're hearing from others. So it looks like the majority are seeing a return to pre-pandemic levels by the end of next year, which I would say is pretty consistent with what we've been hearing. I will tell you one of the interesting observations that we've made through this process is, as we have been asking this question over the course of the last couple of cycles, we have found that the answers have been moving down that chart, particularly for our contacts that were voting in the 4, 5, and 6 range. If they were voting for 4 originally, that may have gotten pushed down to 5. And if they had been voting for 5, that may have gotten pushed down to 6. And so I think that speaks to the fact that increasingly our contacts are feeling like the recovery is contingent not only on people feeling like they're safe. In other words, there are enough mitigating opportunities that they feel safe in re-engaging in the economy, with some saying this is really vaccine dependent or dependent on a very effective therapeutic. And so, again, that's really helpful. Thank you for that. We're going to have one other similar question here in just a minute, but let me tee that one up by going to the next slide. And that's talking a little bit about employment. You know, as you know, we had a tremendous number of folks that were let go at the onset of the crisis. I'm going to show you a picture of that, but let's fast forward to the more recent results. And that was July actually surprised a number of folks to the upside, where we had nearly 2 million jobs added back. The unemployment rate continued to fall. And again, that simply reflected the resumption of economic activity. The next slide is the one that I referenced earlier that to me is really the most striking. And I'm gonna take a few minutes with this one because I want to be sure that you understand what you're looking at. So if you'll focus first on the left side of the page, you get a sense for when those mandated closures began in March, what happened with employment. So we went from averaging right around 200,000 net new jobs being created every month. And by the way, if you look at that, you can see that the colors represent the different sectors where those jobs are being created. And you also notice that they were all or nearly all on the positive side of that zero line, meaning that the net number in effect was simply the number of all of those jobs being created, because there weren't any jobs being destroyed or being undone, so to speak. And then you get to March and you see how the mandated closures impacted not only the economy as a whole, with us losing somewhere in the neighborhood of 1.4 million jobs, but how it impacted particular sectors. And I point this one out because of your location. Most of the folks on the call today are in the Central Florida area. And you can see how the sector that is such an important part of your economy was impacted, again, just looking at March, losing nearly 700,000 jobs in 1 month. Now move your attention to the right-hand side of this page. That column, look at March again. Just in order for us to get this thing on the darn page, look how we had to squeeze March up. So those 700,000 jobs that were lost ended up looking like nothing compared to what happened in April, where over 20 million jobs were lost. And so, again, focusing on the leisure and hospitality sector, just from month to month, we went from losing 700,000 of those positions to 10 times that during the month of April. So again, if we had tried to chart this using the left-hand side of the page, we would have all needed much longer screens in order to be able to see that right now. The good news is post-April, we have begun seeing jobs returning. And so as some of these mandated closures, that period expired, as we went into reopenings of the economy, you saw people being brought back to work. And so while we've got a long way to go to recover all of the jobs that have been lost, you can see that we're getting somewhere in the neighborhood of a third to halfway back. And so what I want you to look at on the next slide is what job losers are telling us. And so this is a picture of what folks who have lost their positions have told the BLS in terms of how they characterize their job loss. And what I really am trying to draw your attention to are the orange and blue parts of these columns. The orange is representing folks that have lost their jobs whose perception is that those job losses are temporary. In other words, they will be called back to their job, as compared to those in the blue box who perceive their job loss as being permanent. In other words, rather than being a furlough, which in most cases the expectation is the individual will be brought back, the blue is you're laid off, you are permanently separated, and you should be out looking for a job with another entity. One of the questions that we had back in that April and May timeframe was how accurate is this understanding from people who have lost their jobs? And fortunately, for the most part, those that felt like they were on temporary layoff, so far anyway, have seen their jobs very slowly return, because you can see as you look across the right-hand side of the page, the orange bars are getting smaller and the blue bars are not growing significantly. And so that's encouraging, but of course we continue to watch that. The hope is that you see both the orange and the blue get smaller. But what we certainly don't want to see is that the orange becomes blue. We're looking for those to continue to shrink as the economy continues to recover. If you go to the next slide, you'll see what the from another perspective, what people who have lost their job are telling the BLS in terms of why they've lost their jobs. And so here, rather than characterizing the job loss itself, it's giving their perception of why they were actually let go. And this is actually a weekly survey, and what you're looking at is information for the state of Florida. And so the highest level there is folks saying, hey, I was laid off due to the pandemic. I mean, no big surprise there. But you can get a sense for how reactions have changed over time based on employee perceptions. And so things that we're watching, if you look on the right-hand side of the page, why did I lose my job? Well, my employer experienced a reduction in business due to the pandemic, or my employer closed temporarily due to the pandemic. And so having this kind of information, again, provides us more of a real-time sense of what's happening in the employment markets. And then the next slide is the committee participants themselves. So what do they think is ultimately going to happen? In this case, using the unemployment rate. And here you see that the central tendencies got the committee seeing us landing somewhere in the neighborhood of 8 to 10% as of year end, which would tell you that at the time this was submitted, and again, this is going back to June, in my view anyway, the committee was still somewhat pessimistic. It'll be interesting to see what happens when they get an opportunity to update these projections in September, because as I said, we've gotten a couple of reports that have been a bit better than expectations. So it's possible that we could see the committee adjust this a little bit. But again, you see us getting back over the longer run based on the best guess of individual committee participants to around 4% unemployment. So let's take another poll. This is the last time we'll ask you to do this. But this, again, very similar to the last time, except in this case, we're talking about headcount. So again, the first couple responses are getting at if the entity increased headcount during the early part of the pandemic, then the question is, will it remain elevated or will it come back down to pre-pandemic levels? 3 is basically saying, hey, our headcount didn't change and we don't expect it to change. 4, 5, and 6 are getting at headcount reductions, and then when will you return to a pre-pandemic level of headcount? 7 is, hey, employment declined and we don't expect it to ever return to pre-pandemic levels. And then again, 8 is we've had a cut, which has to do with either closing or shuttering parts of a business. So again, like last time, we'll give everybody a minute or so to chime in there, and it gives me an opportunity to have a sip of coffee. So think through that and go ahead and make your vote.
And Chris, while they're doing that, do you mind just providing some context on where these questions arose from and what you use these for in your day-to-day?
Sure, it's a great question. And I appreciate that. I should have shared this. It was kind of interesting when the pandemic began. Very early on, we were using similar questions that got at the level of disruption that our contacts were facing. And again, it still allowed that, you could be disrupted and still be performing quite well. And again, I'll keep picking on the grocery industry, that saw an uptick that we have seen has been maintained through all of this. But what we found over the course of several months is that everybody's disrupted right now. And so we shifted from being so focused on, the level of disruption to, more importantly, kind of a more forward-looking view. And so these are the questions that we've come up with. Frank, I'll mention that, this is not perfect. And one of the great things about being in the role that I'm in is that we're able to tweak along and along. So as conditions change, we adjust the questions and in this case, the multiple choice answers to get at this. I should have mentioned earlier, and your participants have probably done this, that this does not capture every single scenario. So what we've had folks do is just pick the answer that most closely aligns with what they see happening. And so in this case, it looks like the majority of participants have seen employment levels remain about steady, which is certainly something that we would all be happy with. I guess I'm most interested in the responses from 4, 5, 6, and 7, which gives us a sense of when we will get back to pre-pandemic levels. And of course, the response to 7 is also, I think, pretty telling, and that is, will we ever get back to pre-pandemic levels? And so, again, one of the observations I would make in talking to contacts is that we are seeing more and more entities talk about, and I want to put this in a way that doesn't sound harsh, but using the impact of the pandemic to better align their staffing with what their needs are. And so that's a nice way of saying that we have a subset of contacts that are indicating that they will likely have a lower staffing level. In effect, they had allowed themselves to get a little heavy from a staffing perspective. And so they're using this period of time to better align staffing with what their needs actually are. And so that's something that we're watching because that has implications for employment over the longer term. So now I'm going to shift. So the employment, of course, is one part of the mandate. The next part of the mandate is inflation. So we can go to the next slide. And again, just as a reminder, the committee back, 8 years ago, set a target of 2% over the longer run of what inflation should look like. And again, I know most of the participants on this call are very familiar with inflation and why having a little bit of inflation is actually a positive. I always like to use the example of a little bit of price movement basically gives you some insurance away from being at that zero level or actually in a deflationary environment. If you look globally at countries that have experienced periods of deflation, that is really, really hard to unwind. And of course, the tools that we have are focused on controlling inflation rather than deflation. So the way I like to think about it is the 2% level gives you a picture of price movements that aren't so extreme that they would influence your decisions on whether to make a purchase today or a year from today. But it's far enough away from zero that it gives you a bit of a buffer from having to worry about that. The other thing I would draw your attention to is in the quote there at the bottom. Chairman Powell is very deliberate about using the word symmetric 2% objective. And if we go to the next slide, I'll describe why that's important. If you look at the chart, if you fast forward to today's performance, and you see 3 different measures of inflation there. Over the course of the last several years, really since the recovery from the Great Recession began, we have been running pretty consistently below target. And that's the case up until recently, and you see, at least by a couple measures, us approaching the 2%. And then, of course, we had the pandemic begin impacting the global economy. And then on top of that, we had the situation with energy, where you saw energy prices falling earlier in the year. And so this has contributed to now a number of pretty significant misses from the 2% target. The reason I wanted to mention the symmetric word is 2% is not a ceiling. It is just simply a target, which tells me that the committee would be comfortable over some period of time and perhaps allowing inflation to trend slightly above 2%. So just like, again, looking at more recent performance, you've seen some performance below 2%. I think it's conceivable that you could see a period of time when we get to that period, when prices begin moving up again, where you could have the committee being satisfied with inflation running slightly above 2%, so that over the longer term, you end up landing somewhere in a range that's pretty tightly around the 2% level. So that's, I think, an important observation to make, because this whole concept of having inflation target being established back in 2012 is still a relatively new concept. If you go to the next slide, I'll start giving you a sense of what the data is telling us, but also why we're not super concerned that we're even going to get to 2%, at least in the near term. First off, starting with wage measures, a couple things to point out on this chart. The blue line is the one that you're probably most familiar with. This is what the media tends to report. And you actually see that when the pandemic period started, we saw a spike in average hourly earnings. And so that sounds great, right? I mean, who wouldn't want their average hourly earnings to increase? Well, the reason we saw that spike is that we had so many people that were in lower paid positions simply falling out of the workforce. So again, think back to that chart where we lost 20 million jobs. Those people just simply weren't in the calculation anymore. So it wasn't this was actually a good thing. This was actually a really horrible thing. It just happens to be that the people that remain in the workforce on average tended to be the more highly compensated people. So from a broad economic perspective, this is actually a really, really ugly picture, because the people who are least able to afford a disruption were the ones that were impacted the most significantly. I'll draw your attention to the green line, which is an Atlanta Fed measure, but this is a national measure. This is a wage growth tracker that actually uses census data that tracks individuals that remained in their position year over year. So this actually looks at, you can use yourself as an example, where you were today compared to where you were 12 months ago to get the average change. And so that's where you see that. That's really helpful. It takes out some of the volatility, but it doesn't give you a picture of how people that are coming in and out of the workforce end up impacting the overall number. So it's another measure to help inform your thinking about employment. The next slide will give you a picture of what our business contacts think that their cost of doing business is going to look like 1 year out. So again, this is another Atlanta Fed product. And by the way, if you are a business or you have contacts that would like to participate in this, just let Frank or Steve know, or reach out directly to me, and we will work with you to get you involved with this survey. But as you can see, since the pandemic began, we've seen our contacts telling us that their forward-looking view of what their cost of doing business is has fallen a bit. And we think that's due to lower energy costs, lower costs that they're experiencing with things that are very obvious to all of you, like travel, as well as an expectation for likely lower wages going forward, just because of the numbers of individuals that are available. If you go to the next slide, you'll get a picture of what the committee thinks is going to happen with inflation. So again, for 2020, you see inflation somewhere south of 1%, and then slowly making its way back up to the 2% target over the longer term. And then if you go to the next slide, kind of getting to the end of at least where the committee was back in July, you know, no surprises here. The actual Fed funds rate was kept at near zero, where it has been since the pandemic began. And the committee is basically committed to remaining in that range until it is confident that the crisis has been overcome. If you go to the next slide, again, it gives you all of the usual things that the FOMC looks at. And of course, on top of that, we're taking on board the pandemic itself and the impact to the economy based on how the public health situation ends up unfolding looking forward. So what I want to do for the next few minutes is just look at the Fed's response. And this is probably the most important slide in the whole deck. And I say that because of the roles that you play. If you aren't accessing this website, I really encourage you to do so, because it gives you in one place a picture of all of the different actions that the Fed has taken. So if we go to the next slide, we have condensed all of these to one picture, basically. On the left-hand side of the page, you get a sense of the various facilities that have been stood up. A number of these were simply pulled out of a playbook that was established back during the Great Recession, but many of these are new. And rather than going through all of them, I would just kind of lump them into these circles that you see on the right. So the small blue circle is kind of what most of us consider normal monetary policy. So that's targeting overnight interest rates, the Fed funds rate. Moving out, you get lending to depository institutions, which is something that we do, but typically that's done more during times like this that are emergency, unusual periods of time. Then lending to financial market participants, which is something all of you are very familiar with. The Fed stepped in to help financial markets continue to function appropriately, especially during the early part of the crisis. And then probably the most unusual and the newest facility would be lending directly to Main Street, providing support to the financial industry in encouraging lending to entities that are out there that feel like they're going to survive but need a link to get them over the hump. The next slide gives you a picture of the Fed's balance sheet. And again, if you look to the far left, you can see all the things that were done during the financial crisis, which of course during that period of time we characterized as very innovative and quite honestly extreme given the situation we were in. But since then, you fast forward to where we are today, and we're now in the neighborhood of a $7 trillion balance sheet, with most of that more recent increase being our purchase of various treasuries securities, which is something that the Fed has done historically, but just not in the volumes that we have. So kind of wrapping up in terms of where do we go from here, we go to the next couple slides. The next slide with another quote from Chairman Powell is one of my favorite lines of his, and that is, we're not thinking about raising rates. We're not even thinking about raising rates. The continued focus is on supporting the economy. And so the next slide will give you a picture of the last picture I'll show you of the SEPs of where committee participants see the Fed funds rate at the end of the next several years. And so if you look at this, again, based on what these folks knew in June when they did their last submission, unanimous on the committee sees no movement off of zero for 2020 and 2021. Most participants seeing us remaining at that level through 2022, and then finally beginning to normalize up into a range right around 2.5% over the longer term. And again, another quote from Chairman Powell, and that is going right back to what I said at the very outset, and that is the full recovery is unlikely until people feel like they can engage in a safe way in the various things that the economy provides. So the next slide is a repeat of one I've already shown you, and that is where the committee sees GDP going over the course of the next several years. Again, focusing on 2020, you see we're somewhere right around at the median level, -6 or 7%. If you go to the next slide, you'll see what private sector prognosticators see us doing there at the bottom of the page. You got the most optimistic being a -3%, the most pessimistic being right around -9%. And then you can see how they're breaking up those projections based on 2020, the 4 quarters in 2020. So with there being a pretty good sense for a pretty big bounce back in the third quarter, and then some leveling out or again a pullback going into the end of the year. And again, recognizing these are bouncing off of extreme levels. So keep that in mind as you look at this. And then what is the longer term view of the economy? I think the next slide does a pretty good job of showing what the private sector thinks, that this is likely going to be a bit of a slow slog back to normal. I would go even further and share with you that our contacts, for the most part, describe the recovery as, rather than being shaped like an L or a W, most see it looking more like a swoosh. And I would encourage you not to think of the swoosh that you might have on your shoe, but more of a bumpy swoosh that we will likely see quite a bit of volatility here on out based on ups and downs that we experience from the perspective of hotspots, from the perspective of therapeutics, and so on. So we'll end with one more quote from the chairman, which I guess in some ways is my way of saying that all of these projections are certainly uncertain. There's a lot that will go into this, and the confidence levels, honestly, are not very, very big with regard to the projections. And of course, the recovery itself is going to continue to rely on appropriate policy. And while the monetary policy piece, what we're responsible for is a big part of this, the fiscal side, which I haven't even talked about, of course, is also a huge component of this. And I think the story continues to be written on both what the Federal Reserve will do as well as what elected officials will do to continue providing relief and support to the recovery. So I'm going to end there, but I do want to make a couple more, I guess, commercials for everybody. And that is going back to the podcast, the Investors First podcast that we mentioned early on. We were really excited to have Raphael be one of the participants on that podcast. And so I want to thank Steve and Colby again for doing that. And one of the things that was discussed, and there were a lot of different subjects that were covered, but one of those was a conversation about an essay that Raphael wrote about the economic role that ending racism can play, the benefits that the country can get by seeing systemic racism be reduced and in a perfect world eliminated, how that can have a positive impact on the overall economy and benefit everyone. So I really encourage you, if you haven't taken a look at this, to link to that website and check that out. And then finally, one last commercial, that is, we'd love for you to stay connected with us, and an easy way to do that is to simply use this information to sign up for a weekly newsletter that will be sent to you. We get, like I said, tremendous value from relationships with folks like you, so we'd love to stay connected. So with that, I'm going to stop, and I guess Frank or someone is going to share any questions that have come in through the chat function.
Thank you very much, Chris, for your time. And we've had a couple of questions come in. So if you do have any questions for Chris, please feel free to use that Q&A section to send them over. And one of the first questions that we have here, and this is related to a topic we talked about at the very beginning of the presentation, which is the survey that you have and the fact that you do survey, you mentioned the largest revenue producers, but also medium and small businesses. What type of variance are you seeing in the responses when you look at small businesses or large businesses and what confidence they have in the current economic forecast or activities?
Yeah, that's an excellent question. And I'm guessing even just based on the fact that the question was asked, that there's probably an inkling of what the response has been. On average, and again, it's important to say this doesn't reflect everybody, but on average, the larger contacts seem to be performing better or more confident in what the future is going to look like. And that oftentimes has to do with access to capital and credit. As I'm guessing, the person that asked the question is speculating smaller businesses that don't have those same levels of access are likely to struggle a bit more, which is again why some of the facilities that we've been involved with have been set up to support lending into those businesses. But it's important for me to note that Fed facilities are focused on those that are expected to remain solvent. One of the differences between what the Federal Reserve has authority to do and what the fiscal authorities have authority to do is we are a lender. We do not have spending power. So in other words, we have to have an expectation of being able to get that money back over a reasonable period of time. Whereas if there is a bridge that is needed that is more focused on grants or loans that ultimately are forgiven, that would be a decision that would need to be made by the fiscal authorities. And so I share that just because PPP is a great example of one of the programs that was set up as part of the CARES Act that, in my view, and again, I'm expressing my opinion, has been generally effective, particularly in the latter part of that period where we saw an increased number of small businesses taking advantage of that. And so programs like that can be of assistance to smaller businesses, I think are going to continue to be important as we try to bridge to the other side of this particular situation. And so again, the short answer to the question is yes, on average, our smaller contacts tend to be struggling a bit more than larger contacts.
Thank you for that answer. And I guess another question I have here that came in is really in regards to painting the picture broadly, how the Fed measures the success of its program. So, you know, we all know that we pay attention to the equity markets. Most people don't use that as a measuring stick for policy and how policy is interacting with it. But a question here is, you know, with the economic downturn, markets are roughly flat year to date. So question being, how does the Fed measure the success of its programs that it has implemented so far?
Yeah. You know, that's a great question, and it's interesting. I mean, it allows me to kind of go into any number of questions, or I'm sorry, any number of ways of thinking about this. You know, at the end of the day, I come back to the dual mandate. You know, we are focused on, over the longer run, getting inflation back to that symmetric 2% target and getting an unemployment rate ultimately that is more comparable to where we were at the beginning of the year than where we are today. So in a very broad sense, that would be how I would measure the success of the programs that we made. My guess is that the person that asked the question was perhaps thinking more specifically about all of the different facilities that have been set up, the elevation of the balance sheet and so on. In looking at those on an individual basis, I think it becomes a bit trickier to measure the success. I think the broad response that I would give to those is success isn't based so much on utilization of individual programs, but rather the proper function of the financial market that particular facility was stood up to support. And so I mentioned earlier, you know, there's been some criticism of some of the programs, or maybe criticism may be the wrong word, but perhaps observations of some of the programs not being used in a big way. But if you go back and you look at why those programs were set up, sometimes simply the announcement of a particular program can help, you know, in the case of seeing elevated borrowing costs, for example, in a particular market, just the announcement of a program can help reduce those costs as borrowers and lenders see that, oh, you know what, the Fed is involved. There's a backstop if it's needed. And I would make that same observation about programs like the Main Street Lending Program that are out there to serve as a backstop and may be needed as time goes by, depending on what you know, how the economy continues to unfold. And so my sense, Frank, is at the end of all this, there will be a pretty significant evaluation of what worked and what didn't work as a part of this effort. But I will also say, and again, I realize that I'm part of this organization, but I guess I have the ability to be proud of some of my colleagues. I tip my hat to the policymakers who are tweaking these programs in real time. So I guess the other observation I would make is when there's an observation made that things aren't working, there have been changes made to those programs to help them be more accessible, for example. And so again, going back to the website that I mentioned, federalreserve.gov/COVID-19, that gives you a comprehensive sense of what's going on, what's available, and when changes are made, you can see those updates right there in one place. So again, reference your participants to that.
Perfect. A couple more questions that have come in here. One of which is, well, these two are really tied together, so I'm going to ask them as a two-part, and feel free to take whichever one you want to first. We all know that the Fed has a pretty good control mechanism for short-term interest rates. Second one being, how can the Fed control long-term interest rates, and what tools are available there? And secondary to that is, as the Fed continues to increase their balance sheet, money supply changes, how is the Fed looking at that possible increase in inflationary risk with both of those two items in mind?
Great. Okay. So the first part of the question, tools for impacting longer term rates. I mean, you're exactly right. I mean, the primary tool that the Fed has is the Fed funds rate, which of course is an overnight rate. But again, if you go back to the Great Recession and some of the large scale asset purchases that we embarked on during that period, and fast forward to today when we're back to buying different types of securities, there are all types of treasury securities, using those as an example, that have different durations. And so there is an ability to influence rates at different places on the maturity spectrum based on what we choose to buy and sell, right? And so that would be, I think, my response to that question. Where the committee actually decides to go with that, I think is still to be decided. The chairman, I think, has made it very clear that we are likely not done with the policy actions that we will take. And even just within the last week, there was an announcement of the extension of some of these facilities through the end of the year. So again, going back to my previous comment, I think the committee will continue to make changes in real time to help support the overall recovery. And so I would expect that this evaluation of influencing rates at different maturity levels is something that is going to be continued to be debated and ultimately decided by that group of folks. The question about pumping in trillions of dollars and the impact that would have on inflation, I think, is a really great question. And obviously something that all of us spend a lot of time thinking about. And again, inflation is half of the mandate, right? And so it's something that is always top of mind. I would say this, I guess a couple things. One is, one of the lessons I think that was learned from the Great Recession is that things don't always unfold the way that you think they're going to. And so there were all kinds of predictions that the massive increase that we made in the Fed balance sheet would have a tremendous impact on prices, and we would ultimately have runaway inflation. And we all know that that never happened. And I think the reason for that is that a lot of those funds that were pumped into the economy ended up right back into the banking system, and so ended up not driving up prices overall. Now we're at a different place where we've not only, not only do we have the money that was put in for the most part as a result of the Great Recession, but we've added to that based on the more recent crisis. I think the reaction I have to that, and I may have mentioned this, Steve Curley and I were talking yesterday. The way I look at it is, you've got a patient that is dying on the table. I think the immediate reaction is to save the patient. And then we worry about tweaking kind of the underlying health conditions of the patient later. And I think in many ways, that's at least how I view some of the actions that have been taken, is that we had to deal with the immediate crisis. And one way to do that was to very quickly and in a very big way show that the Fed was going to be there to support, to provide relief, and ultimately to support the economy in its role as the monetary authority through the recovery. And so I think that that's been done. Does not mean that inflation is off of anyone's radar. But at this point, again, just looking back on the slide I showed you a few minutes ago, we're actually running below inflation. And again, based on information that we're getting, both in real time as well as the data that's coming in, we're not seeing that inflationary pressures at this point anyway are something that the committee is having to spend a lot of time thinking about. Doesn't mean they won't in the future. And I can guarantee you that, again, inflation is always on policymakers' minds. But at least at this point, for the foreseeable future, I don't think it is a huge issue that they're concerned about.
Excellent. Thank you for expanding upon your answer and answering those questions. So, excuse me, in the sake of time, 8:45 is when we said we would stop here. Before I turn it over to Steve Curley to wrap up, I'm going to ask Chris if you could answer this question in maybe 15 or 30 seconds or less, which is, have you seen any specific trends from Florida that are different from other geographies or geographical areas that are currently being impacted by this?
Yeah, 15 seconds is really tough, but I'll just say this. The answer is yes, and a good part of it is being driven by what all of you are experiencing in the Central Florida area, and that is we have pockets of the state, as everyone knows, that have a disproportionate number of tourism hospitality jobs, and so that is certainly something that's unique to the state. So I'll leave it at that.
Well, thank you very much for your time and patience with the answers. We greatly appreciate you sharing your insight and even some specific questions from the surveys that you asked from the Federal Reserve side. So with that, Steve, I'll turn it over to you to wrap the event up.
Thank you, Frank. And thank you, Frank, for hosting our first event of the fiscal year. We hoped to meet in person, but virtually, I think, worked out really well. Thank you for coming out this morning. We're trying to get you on and a shout out to somebody I don't see at events. Jeff Bernardo, Florida. Thanks for coming out. I know Chris knows Jeff pretty well. And Chris Oakley for joining us. Something every time Chris speaks. And really impressed with the work that they're doing. And also for getting Raphael Bostic on the podcast. I think we continuously hear positive feedback from that, and we're able to address some really interesting and timely points and topics with that podcast. Colby and I, just we're blown away by Raphael and the work that he's doing and his ability to dynamically quickly just motoring through this. I know everybody has to drop off work. Congrats to winning global awards from the CFA Institute. Chris Cannon for the Ethics Challenge, Colby for the podcast. I was told that they can't give out multiple awards, so we're just an honorable mention in the top size. So no in-person events through end of year. We think some element of virtual programs and actually better than virtual programming in many regards today. I actually think we're going to have more than we had last fall, believe it or not. It wasn't until September last year. We're already at schedule with this event. I think all of our members we're one of the few societies globally that we choose to support the tourism economy, even though we're mostly finance. We were the best deal, in my opinion. The best deal in town. We're the only organization, and now we're free to join this year. So we hope you guys all get value. Starting with coffee, there used to be egg bites. I highly recommend those. And then thank you to those who donated to Second Harvest Food Bank. We raised approximately $8,000 thus far with this campaign. Many people are giving their dues to Second Harvest since we gave them, and we're matching $1 for $1, $8,000 with that program. We're hoping to make it to $10,000 by the end of next month. Have a great day. Thank you for attending.
Thank you very much, everybody, and stay in touch with us, and you'll hear other events moving forward. So thank you, and have a wonderful rest of your day. We appreciate your time.